How does the stock market works? What is the need of stock market?
What is the need of stock market? And how does stock market works? Are some of the most common doubts in the mind of a new investor. To answer these questions, let's consider an example. We all buy vegetables, right? Do we buy it from a farmer or from a vegetable shop? I guess most of us buy from the vegetable shop. Why don't we buy it directly from the farmer? The answer to the question is the reason for existence of vegetable shops. The same is the case with stock market. You can't purchase stock of a company directly from the company itself. A mediator is required. The mediator here is the stock market. Whenever someone buys a stock, one person sells it. There is a link which connects both of them. The stockbroker here acts as the link.
What is the history of stock market?
Everything has a past. The same is applicable to stock market also. So, before learning about how the stock market works, let's know about its history. The merchants of Venice are credited with the trading of government securities in the early 13th century. But the first genuine stock market arrived in the 1500s. Antwerp was the commercial center of Belgium at that time. The main means of transportation at that point of time was through water. So, they had to send it through the ships. They started financing more than one ship, so that if one ship faces some kind of accident, then the others will execute their trades. The success of this idea led to the formation of similar charters to other businesses in England, France, Belgium and Netherlands. Coffee shops were generally used as trading floor at that point of time, where handwritten sheets of paper were considered as stocks and traded.
How does stock market works?
The term stock market is used for the market where stocks are bought and sold. The stock market can also be referred to as the major indices of the market. Like India has two stock markets. One is Bombay Stock Exchange, BSE, and the other is National Stock Exchange, NSE. Both markets have their own index, which tells about the direction of market. The main index of BSE is Sensex, and that for NSE is Nifty 50. The movement of the market is judged on the basis of its major index. The operation of stock market is quite similar to that of a vegetable shop. The different vegetable available signifies the different company, and the different customers are traders. Everyone visits there to buy vegetables. Although he will buy the vegetable only when the price seems to be appropriate. Now, the trading price of the vegetable depends on the capability of the customer. This is somewhat the case in the stock market. A person buys a stock only when the price seems to be appropriate, and the same is with the seller. Although there are cases of loss, which arise due to the inefficiency of the individuals.
What are stocks?
A stock, or share or equity, is a financial object which signifies ownership in a company. It also represents a proportionate claim of the buyer on the assets and earnings of the company. Stock ownership points out the slice of the company equal to the number of stocks held as a proportion of total outstanding stocks of the institution. For example, if an organization or a person holds 100,000 stocks of a company which has a total outstanding of 2 million stocks, this means an ownership stake of 5% belongs to them.
Tell me about the types of stocks.
The broader category of stocks is mainly divided into two types. 1. Common stocks. The term equity is considered as the synonym of this type, as the common stocks have greater market value and trading volumes in comparison to the preferred stocks. They also carry voting power, which enables the holder to cast vote during the corporate meetings, such as election of board of directors, appointment of auditors. They are further divided into types on the basis of their voting rights. Conservatively, one share has one vote. But, in some cases there are companies which provide more than one vote per share. Preferred stocks, they do not have voting powers attached to them. The logic behind their name is the respective preference they get over the common stocks, in cases such as dividends, assets in the event of liquidation.
Why does company issue stocks?
The primary requirement of any business is having an idea, and the secondary necessity being capital to execute that idea. Imagine the case of Facebook, which was started a couple of decades ago. The pace of its growth has been very high. The growth at such a high pace requires access to massive capital. The transition of idea into a business requires leasing an office or factory, buying equipment, hiring employees, and many more. All these things require money. There are two main ways of raising capital for a business. The first way is selling shares, and the second way is borrowing money. The option of debt financing or borrowing money is not easy for a startup as it lacks enough assets to be pledged. Therefore, equity financing or selling shares is the more preferred option for raising capital. The entrepreneur can initially source funds from personal savings, friends or family. But as the capital requirement widens, she has to turn towards the investors or the venture capital firms. When the company gets established, it requires more amount of capital. This capital can be raised by selling shares to public through initial public offering (IPO) in the stock market. This shifts the status of the company from a private firm to a publicly traded company, whose shares are held by numerous members of public. The IPO also provide the early investors an opportunity to cash out their stakes.
Why do stock prices fluctuate?
The stock market is constituted of millions of investors and traders, who acquire different mindset about the value of a stock. And thus the price also differs for all. The individuals or entities to convert their intentions into action by buying and or selling stocks, this becomes the reason for the fluctuations in prices. The stock market is a great example of the laws of supply and demand that works in real time. For every stock trade there has to be a buyer and a seller. It is due to the laws of supply and demand that when the number of buyers is more than the number of sellers, the price of the particular stock moves up and vice versa.